There's something going on that we haven't seen since 2008. In fact, we've actually never seen this ever. The way that gold is behaving is very unique and is raising a bunch of red flags because gold is generally that leading indicator for inflation and that debasement trade that everybody is talking about these days. But why, oh, why are we seeing gold's monthly RSI hitting 91.5, making it's the most overbought level on record? Not even '01, '08, or 2020 saw a reading this high. And now on top of it, gold is absolutely crushing the S&P 500, nearly four times the return of what we normally see, or what we have been seeing, excuse me, from the S&P 500 in this year. So what is that warning sign that gold is sending us? Is it sending us that warning that, hey, everybody's worried about inflation, or is it the potential of this debasement? We're going to dive into all of this today. But first, we're going to talk about how the inflationary aspects of the US dollar absolutely plummeting have to do with what we've seen here with gold. Because the dollar has been more volatile than the S&P 500. Now, with this, right, we've talked about the debasement trade and other aspects, but this is only the third occurrence in over 7 years after December 23 and July 25 that we've seen this amount of volatility. The April sell-off, the realized volatility ratio between the S&P 500 and the US dollar have jumped to 6x, the highest since 2020. Now, this comes as the dollar is on track for its worst year since 1973. Literally, there's been one time the dollar has had a worse year since we came off the gold standard, and that is 1973. Literally 2 years after we went off the gold standard in 1971. So some craziness is going on in the dollar market, and that is why everybody is flocking to an asset like gold. Now, the dollar is being sold and asset prices are skyrocketing in flight, as I love to say. But even with gold acting like it is, the S&P 500 is still having an incredible run. It's now up 34% in the past 6 months, a move seen 10 previous times since 1930. And in 8 of those previous 10 occurrences, it ended up lower 2 weeks later with an average of a 3.5% decline. So, this is essentially showing us that the market is potentially overdue for a quote pullback because of the way that we've seen asset prices absolutely erupt. We are seeing the S&P 500 go on a run that we've basically never seen before. And in our lifetimes, as we're watching this here, the only times this happened is during way overpricing the market, as in the dot-com boom. Obviously, we saw COVID 2020, what happened there with the massive amounts of liquidity just injected into the market. And this is continuing to see and show signs of a way overvalued stock market. One, we have the dollar, the Dixie, absolutely plummeting, but it's doing a little bit better if we're taking a closer look here today at 98.8, but we're still at a pretty poor year to date stat, down 8.9%. Now, if we didn't see this recent uptick that we've seen in the past 5-ish days in the past month, we'd be down over 10%. And if we were down over 10%, that'd be the worst, worse than it ever was, even including 1973. So, in fact, we need this little tick up here to get better than 1973, the literally the worst year on record for the dollar. So, we need this last quarter to actually be pretty solid for the dollar if we don't want to avoid or see something catastrophic. Now, in about 3 weeks, we are going to see the Federal Reserve do something that I think is unprecedented. We have never seen the Federal Reserve cut interest rates when when inflation is where it is. We usually see it with inflation near that 2% target, but now we have inflation near a 3%, which is essentially moving that bar. Now, the Fed is essentially stuck between a rock and a hard place if you really break it all down. That rock is low jobs, not a lot of job market movement. The hard place is asset prices absolutely moving and being overinflated and everybody flocking out of the dollar, as well as inflation going up. So essentially, you have to either try to battle inflation and suffer the American people by not allowing them to essentially get hired with jobs. These corporations aren't hiring. So you have to do one or the other. Something's going to have to break. And it looks like the dollar is that thing that is ripe for breaking and disruption, even with the S&P 500 skyrocketing in flight and hitting all-time highs. I mean, it's closing at an all-time high here today at 6,753, absolutely exploding onto the scene. Now, we're going to potentially see the S&P 500 continue to go on this run, but the unique thing that this stat lined out was, hey, with this S&P 500 where it is, we're due for a pullback. So I'd love to hear you guys in the chat or in the comments. Let me know whether or not you think we're due for a pullback, and make sure you guys are hitting that subscribe button for me, because are we? I mean, the way that everything in this market is lined out, if we're going to cut interest rates and bring it down, that, interest rate value, even though the S&P 500 and the market in general has most likely priced in 3 cuts this year, if we have a cut and we continue to have another cut here later in December or late November, whenever that next meeting is, are we going to have a crash? I don't think so. If everything goes according to plan, I think this quarter is going to be something immaculate for all assets because of what we've seen lined out here. So as we get deeper into what we're seeing as the quote unquote debasement trade, you got to ask yourself, with gold where it is and the US dollar becoming more and more volatile, where are things going on? I mean, the government, as we're lining out, it's borrowing that $2 trillion per year. It's shut down for the 11th time, printed $4 trillion during the pandemic, 25% loss in the USD in the past 2 years. I mean, that's historic. We've seen the US dollar essentially be on a ginormous bear market, but we've never seen this 2-year sprint like we are seeing here today. So it spends close to 7 trillion per year. And I mean, as I've lined out with you guys, right? The tariffs, all of that aspect, it's bringing in more money, sure, but the government has a spending problem. And this is what Doge was attempting to correct. Now, I don't think we're there yet. And Doge obviously has had its problems and has, now not necessarily getting into all of those different aspects. But, Elon's gone. And whether you like him or not, he was trying to have the government spend less money, and we've seen GDP get cut. We've seen all these different writings on the wall here. And at the end of the day, we're going to be looking at the US consumer and following along on how this is affecting the overall market. And the borrowing is slowing. The credit's rising by 363 million in August, the slowest pace in 6 months and far below expectations. So we're seeing all of this go back and forth, and then a sharp 18.1 billion rise in July. It's been a slowdown here recently. We're going to be keeping a very close eye on how this last quarter plays out, because I think this is going to be very important and honestly a really defining quarter for this presidency here, especially the first year in, as we're seeing potentially massive amounts of inflation. And then Jerome Powell, he's going to be out in May next year. So a lot of different factors, a lot of moving pieces. I'm going to be following it all for you guys. So make sure you guys are hitting that subscribe button for me, hitting the like button, telling a friend to tell a friend, and I'll keep this one short and sweet. Catch you at the next one.